As you know, in a bank, the assets of a bank really are the loans that the bank gives out. The deposits in a bank are liabilities because these are money that I owe to the public that deposited the money with me. So the assets in the bank are the loans that I give out. So they evaluate the loans. Are the loans paying on time? First, if the decision to give the loan was done properly, so they sit down and read the memo that was produced by Alex and Dan and Wilson and others in the credit department and make sure that the loan is paying on time, make sure that the current financial condition of the borrower has been studied on a regular basis to make sure that it has not deteriorated, and so on and so forth. That's the assets. M is management. They want to make sure that management is taking care of the bank. They not only manage people, they manage the funds, manage the credit, manage the technology, and. E is earnings. See if the bank is got good earnings or it's losing money, because if the bank loses money, what you're doing, you're eating away from the capital of the bank, and this way it exposes the bank and the depositors to negative repercussions. And then finally is liquidity. Is the bank liquid or not? Why? Because you want to have cash on hand, so if some depositors come in and say, give me my money back, you will have to be able to give them money back. You can't tell them that, I'm sorry, your deposits are invested in the homes and the cars, come after 2 weeks, because that will affect your reputation. That's why the examination called the examination for safety, that is safety of deposits and safety of operations, and also soundness, that the operation is sound. The common rating ranges between 1, which is the highest rating, and 5, which is the lowest rating. The most likely rating for most banks is a 2, which means you're good. If you go to 3, then red flags start being raised. If you go to 4, then you'll get what we call an MOU, Memorandum of Understanding, that you have to always consult with the Office of the Controller of the Currency anytime you change management, anytime you move, anytime you do anything. You have to notify the office, and the office has to give you approval. And then when you go to 5, then they give you what we call C and D, which is cease and desist. C and D means you have to freeze all of your operations, look at it on the inside, make sure you are fixing your problems, because if you don't, they will shut you down, according to a plan devised by the OCC. The objectives of the OCC ensure the safety and soundness, foster competition by allowing banks to offer new products and services, improve the efficiency and effectiveness of the supervision, including reducing the regulation burden, that's what they claim, ensure fair and equal access to financial services for all Americans. As far as the banking regulations, most important thing is consumer compliance, because the minute you handle consumer business, and the biggest of all consumer businesses are 2. Number 1 is car financing and home financing, and number 2 is credit card activities. These are huge. And in the Bank of Whittier, Alex is the chairman of the compliance committee. And we make sure that when we open an account, we have compliance. When we serve customers, we have compliance. When we deliver information technology, and the chairman of that is Bill Stilwell, making sure that everything is intact as in good shape. And then the financial accounting operations, also regulations. How do you express, for instance, suppose I did a loan of $1 million and I charged a fee, origination fee of 1%, which is 1% of $1 million is $10,000. How would I book this in the bank? Am I going to put it as a profit this year? And that's not fair, because you are misrepresenting facts, because this $10,000 is not really produced from actual banking operations. It's a fee. So the government says you have to spread it on the life of the loan. If the loan is 10 years, every year you put in $1,000 as income, and so on and so forth. I'm not trying to bore you with the accounting standards, but this is one of the requirements. And then, of course, internal controls. One of the most requirements is to continually train our staff. And this is something that we do through the Open University on twice a year basis, where we visit all the regulations, we watch movies to make sure that you understand how the regulations apply, and so on and so forth. And then, of course, the audits that I told you about. I'll give you examples of the regulations, and of course, these are very well known to those who attended the Open University. Regulation B is got to do with equal credit opportunity rights. You cannot discriminate. You cannot discriminate amongst people because of their color, national origin, language. And to my knowledge, there is nothing like this anywhere except in this wonderful land, America. Home Mortgage Disclosure Act, you want to make sure, and this is HMDA, known to Pasadena, known to Whittier. What are we doing? We want to make sure that when somebody makes an application to us, we want to know who he is, his ethnicity, his age, his background, his marital status, where he's making the application, and so on. And we want to know if Whittier and Pasadena received 1,000 applications, how many of these applications were approved? Did they approve all of them? Did they reject all of them? Did they reject 20% of them? And when it was rejected, why did they reject it? What is the reason for rejection? To make sure that it was not a systemic and systematic discrimination inside the company operations. Not only that, and if you gave a loan, how much this loan was? Where was it given? Are you giving it in a certain area only and not the other areas? Are you giving it only to the rich and not to the poor? It's an amazing system that has been devised, and it continues to be improved upon. Regulation Q is repealed partially. Regulation Q says that you cannot give interest for demand deposit accounts. Why? A demand deposit account of a customer that comes to you is really a trust. They come to Mustafa and say, Mustafa, you're my banker. Here's $100,000. I want to demand it anytime I want. That's why it's called demand deposit account. Now, of course, by the mere fact that Mustafa is a good banker, he will never invest this money in financing a home for 30 years or financing a car for 3 years because, you know, maybe the demand depositor will come in after tomorrow and says, I want my money. You can't tell him I don't have it. I invested. So, well, no, I never allowed you to invest it. And that's a very unique thing of RF banking, that whenever there is a demand deposit account, that cannot be invested. It has to be kept in cash on the premises of the bank. And then the reserve requirements and Regulation O. Regulation O says that if I lend to my daughter, if I lend to my wife, if I lend to myself from the bank, you have to disclose this to the government. Why? Because the government wants to make sure that you're not giving yourself preferential treatment. You have to charge yourself the same rate as you charge to others in the market. So it can be a very fair process of operations and lending. Privacy. Now, the question is, when I deal with Afatah Sukar, I will know everything about Afatah Sukar. I will know his name. I will know his social security number. I will know everything about him. Now, the question is, can I share that information with the outside world? The answer is never. And can I share this information with the government? Well, they have two programs. One program which allows the banks to work with the governments, but we do not participate in it. And the other program requires banks to give information to the government only if there is a court subpoena issued. And that's the program that all banks are supposed to follow and respect. Regulation Z, which is a very important regulation. Whenever we borrow money from a bank, the government says, well, we have to tell the customers what the implied rate of return, right, interest rate is. And it has to be done in a way that is uniform, such that when customers compare a rate that they get from Wells Fargo, it will be the same as the rate they get from the same comparison as they get from Bank of America as Bank of Whittier. So when you make the decision using apple for apples comparisons, orange for oranges comparison. That's number one. And number two, when you are doing a financing, then you want to disclose also how much are these costs and how do you impact the implied interest rate. I'm sure you are aware of the truth in lending disclosure that is produced in Pasadena, correct, Mustafa and Sukar?
Yes.
And also in Whittier. We add all the expenses, all the costs, and in the bottom line it says that the implied interest rate is X. So now I know that X compared to others. Like for instance, guidance. I don't know if they include their 1,450 fee. Is it included in the Truth in Lending, Mike, or you haven't seen it?
I think they include that because that's on the HUD, but they do not include the $1,875 a month in the rate.
Well, they will have to include it very soon, I promise you. But the question is, and this is the key thing. The key thing is when you want to compare rates, you compare rates not by the pronouncement of the salesman, but by the bottom line, which is required by the TILA or the Truth in Lending Act. The Community Reinvestment Act, everybody in Whittier knows about the Community Reinvestment Act, right, Dan and Alex and Mike, and Community Reinvestment Act is a very, very important act, really. And I am taking it to every country that I go and make presentation at. Because, unfortunately, most of the developed countries, here's what they do. You open a bank, and the bank really is nothing but an auxiliary to importing goods from the country they come in. So at HSBC, they are an auxiliary to import things from England and to some extent Europe. If it is a Citibank, then of course the United States. If it is a Japanese bank, then it is Japan, and so on and so forth. So what happens is deposits come to these banks because they're international banks, but only 30 to 40% of these deposits are invested back in the economy in the form of loans. And these are loans which are short-term, from 30 days to almost 1 year. They never use this money for long-term significant projects that will have an impact on the local economies. So the Community Investment Act is a fantastic act. Why? Number one, it requires that if you are collecting money from the county of Addis Ababa, then at least 50% of the deposits have to be invested back in the county of Addis Ababa. Let me repeat this. If we are collecting money from Whittier, then 50% of the deposits that we get have to be invested back in Whittier. Is that clear?
Yes.
Number two, if you are collecting any deposits in the bank, 50% of these deposits have to be invested in loans. Now let's assume a case. Suppose we have a bank like Whittier, and we have deposits of $100 million. So the government says $50 million have to be invested into loans. You have to lend this money by horse or by force. Don't talk to me. If you don't, you're going to be cited for it. So you got to finance cars, you have to finance factories, you have to finance commercial buildings. This way you create economic prosperity and job opportunities. Second, it says that out of the $50 million in loans, $25 million have to be loans inside the assessment area that is defined by the bank. And number three, which is very important, that these loans have to be given to a representative sample that represents the distribution of demography and income of the people in that area. So you don't only lend to the rich and you forget the poor, or lend to the middle class and forget the poor. It has to be evenly distributed. Is that clear?
I have a question, Dr. Raha.
Okay.
If you don't have enough applicants coming from the community you're in, what happens? I mean, if you have 100 million...
You know, this is a very interesting question because everybody asks that. Well, if you don't have enough clients, then there is no need for that bank. Close the bank.
You have to move out of that locality?
You have to move out of this area, or you're not needed. There is no market need for you. You see the whole idea?
Yeah.
I'm telling you, it's a very ingenious system. And I promise you, if you go back to Ethiopia, where you come from, you will find that most of the banks lend only 30%, 35%, short term, and only name lending to big companies, not to the poor and the needy. Do you agree?
Correct. Yes, that's true. Yes, that is very true.
And then when there is surplus funds, they are not invested in the economy. They are invested in the London market, in the money market. So you are really depriving the whole economy from any prosperity. Do I make sense?
Yeah, it does.
Okay. So, and I'll let you read the rest of the stuff. I also wrote about a fantastic bankruptcy protection law. The bankruptcy protection laws that are existing in the United States that will give a chance to people, and this is called in the Quran al-Gharimin. How do you handle the Gharimin, the heavily indebted? Well, by giving them a way out, and that is through the bankruptcy laws, and I will let you read it. Let's go to the next chapter. This is a short chapter, and it really has to do with a value-oriented chapter, and I wanted you to reflect on it. It's an intellectual exercise, which I hope you will find enjoyable as you read the details of it. The question is, many people ask you, what's the difference? So the average person says, it does not have interest, it's interest-free. The word interest is not there. But that is really a very mechanical definition. It does not delve deep in the spirit, in the meaning of what we're trying to do, whereby we're trying to make a difference in people's lives, make a difference in the way people live, make a difference in the way people think, hold their hands to make a difference in their outlook on life. And when this story, I promise you, when this story is known to the outside world, all people of all faith, of all backgrounds will be rushing to you, and it will be a huge brand that people would love to deal with. The question is, what is the difference? And I want to go with an overview of the history of RF banks, which we talked about before. When the man came from Europe, he found that the farmers do not have the money to buy the seeds, to buy the pumps, to irrigate their land, and he started this cooperative. And then I remember I read my first book on the subject in 1959, by a very revered professor. His name is Yahia Abdul, who was of the Christian faith at the time, and he got attracted to the idea of riba-free banking. He wrote a book called Banks Without Interest in 88 pages. And then, of course, the oil price jumped and what happened, and then the IDB. I'm going to let you read. I'm going to have this, by the way, I have a better picture now, which I can share with you. It's a bigger elephant, and I think we talked about that before. That the real issue is not the contracts, the real issue is not the advertising, the real issue is the monetary aspect of the economy and how you price things. You price things based on a reference commodity, which can be a metal commodity, gold, silver, platinum, rhodium, whatever is available in the economy. It can be a natural resource like oil, natural gas. It can be food, something that has an intrinsic value with which you can live or exchange goods and services for. So what I would like to do, I'd like to summarize the foundations of the RF banking. The one and most important foundation is that credit is a basic human right. In other words, if I were to rewrite the Code of Human Rights in the United Nations, I would put in it that credit, giving and obtaining credit, is a basic human right, like liberty, like dignity, like justice, as revealed in the United Nations human rights, whatever. Socially responsible and ethical. Socially responsible means that we do not embark on non-social responsible activities, alcoholic beverages, gambling, illicit activities, taking advantage of people, who happen to be immigrants in the United States, don't have a bank account. So I open a check cashing facility that charges them money, which sounds like a small amount of money, but when you calculate the implied rate of return, you apply TILA on it, or Truth in Lending Act, you will find that they're making as high as 60% return on investment, or 60% interest on this money. What they call paycheck lenders. Have you seen those these signs on, usually in South Central Los Angeles and places like East Los Angeles? Have you seen those driving around? Any of you? Paycheck lenders, you go out and you give them indication that you're getting a paycheck in 2 days and you have to make the monthly payment on your apartment and so on. So they give you $200, but they charge you $20. That is 10% to be paid in 2 days. Can you believe that? 10% paid in 2 days. And you calculate how much is the rate of return on investment. It can be humongous, about 500%. And believe it or not, it is there. If you want to read about it, go and Google it. You'll find tremendous research done by the Treasury Department, and also many articles on the subject in Wall Street Journal. The third point is designed to deliver services to the community according to the guidelines of what I call the Judeo-Christian Islamic system. And it finances businesses in a fair and just way, serves all customers of all backgrounds, all religions, with no discrimination. And we scrutinize the business that we finance to make sure that the owners of the business treat their employees fairly without discrimination. The RF bankers believe in equal financing opportunities without discrimination, and I think that is obvious. It enjoys the advantages of low overhead, and the reason we have low overhead is the fact that we have men and women who are motivated by servicing people and are very efficient in their productivity. And the most important thing about the low overhead is that the percentage of bad loans is lower than the average riba-based banks. Why? Because we focus on knowing our customers, getting to know them as much as possible. As a matter of fact, we may be one of the very few banks and financial institutions that require a resume of the customer, that require that we talk to the customer, know how many kids he has, how old are his kids, and if they are credible or not. We pay a lot of attention to the credit reports and so on, and this is something I appreciate in the credit department, in the underwriting and so on and so forth. So your losses are lower, and because your losses are lower, then the overhead is much lower than the other banks. And the second thing is we try to negotiate prices. So that is one of the advantages. And then is built on asset-based financing. In other words, we do not do unsecured loans. Loans have to be done as an actual honest-to-goodness financing facility that is based on an asset that is financed. It is not a money lending operation. We do not rent money, and that's our motto. We invest in our customers, and we train our staff, our credit department, to think as investors, not as money lenders. It invests in specific activities that are well known and believes, and this is very important, that speculation and its tools and paper trading are divinely prohibited. As a matter of fact, many banks, and they are doing it again, would take the loan that they give and put it in a derivatives basket, and that will generate income for them that will result in a reduction in the interest rate. Many banks go out and borrow money from the Federal Home Bank of San Francisco, the Federal Home Bank of Texas, and this money is borrowed at 1.5% or 2%, and turn around and lend it at a rate of 4% or 3% and 3.5%, and they make money on the spread as much as possible. We don't do these games. We think that it is prohibited. So we talked about this, and then it's not a money lending operation, and believes in financing the community development, promoting community development activities. That's why we do a lot of churches. We want to do a lot of schools, a lot of Islamic centers, a lot of Jewish centers, and so on and so forth. And wealth should be circulated through the Community Reinvestment Act. And the prime objective is to remove riba, or the culture of riba. The culture of thinking of money that's something that you can rent at 6%, so you can consume as much as you can, and in the process dig a deep hole of debt that you cannot get out of. And I'm sure each and every one of us knows people that lost their homes, lost their cars, in many cases lost their families. They got a divorce because of the promiscuous activities and over borrowing. And one important thing, we're not out to destroy or compete or put out of business the riba-based conventional banking system. We're out only to compete with them, to offer an alternative to the people to choose from. And we measure our success by the rate of return on investment. We do not believe that paper money is a good measuring device of value, and we talked about the commodity indexation in our discussion. We believe that the value is to be defined reference to a certain commodity, and full transparency is a must. Now let me give you a summary of some important comparison parameters. What is the dominant attractor in, there are two systems, the riba-based system and the riba-free system. The most important attractor in the riba-based system is money. If you got the money, I can talk to you. If you don't have the money, I cannot talk to you. In the RF system, it is life prescribed by Almighty God, be it in the Buddhist faith, in the Abrahamic faith, in the Judeo-Christian Islamic faith. It is the person that you're talking to, who you are dealing with, what added value they bring to the table. It's not only money, it is their expertise, their know-how, their values, their acumen, and so on and so forth. What is the defining purpose? In the riba-based system, it is, and this is very, very factual, it uses money to make money. So it tells you, if you have money, you will make money for those who have money. So if you don't have money, you are out of the game. You are out of the picture. In the riba-free system, it employs the available resources within its means to meet the basic needs of everyone without extravagance. So the question you are faced with as a riba-free bank, would you finance one car for $100,000 or 5 cars for $20,000? Of course, if you do 5 cars, it's more headache, more administration costs, more servicing costs for Matthew and Mia and so on. The answer is we will do the 5 cars because this way we can impact the lives of 5 families. The $100,000 person is a man who's got money, who works with people who believe that money makes money for those who have money. But in our case, we deal with the people who need our services. Next point is bank size. The riba-based banks actually, they tend to be very large. How? They want to limit competition. How? By buying all the competition, buying branches, buying outlets, so they can be bigger, and they maximize the return by reducing overhead by automation. And this reduces the mega banks. And they are needed, of course. And the riba-free banks are small to medium size. Ownership in the riba-based banks, it's a very impersonal ownership. The shareholders are essentially absent. They buy the shares on the stock market, but they don't have much impact on the policies of the bank, if they participate in speculative activities or not, until something happens and then everybody wakes up and then afterwards they go to sleep again. In the riba-free system, it is personal because the shareholders are known to each other and they are smaller. And the financial capital in the riba-based system, it's global, has no borders, but in the riba-free system, it focuses on the areas where you operate using the Community Reinvestment Act. The purpose of the investment, the whole idea behind riba-based banks is to maximize profits and wealth. In the riba-free banks, it increased the beneficial output to the community to make it prosper. So we want the community to prosper, and we believe in the long term if the community prospers, then the whole country will become prosperous and not composed of small islands of very rich and then huge oceans of very poor people, as you see in many countries, including the United States. Profit, it's an end to be maximized in a riba-based bank. Profit is an incentive to invest productively in the community. The coordinating mechanism in the riba-based banks is central planned, all run from a central office headquarters. In the riba-free banking, it is done on a case-by-case basis, on a branch-by-branch basis. And by the way, this is the way we are going to evolve into Dallas. We're going to evolve into Chicago. We're going to evolve into New Jersey. We're going to evolve into New York. That every unit will have its advisory board of directors, which are being formed now in Dallas. Every unit will have its own management, but the values, the systems are the same. The cooperation in the riba-based systems, they cooperate among competitors. Why? We want to escape the competition. In the riba-free bank, the cooperation among people and communities to advance common goods for all. Competition in a riba-based operation is to be eliminated, because the more you eliminate the competition, the more you are in control. But in riba-free operations, we believe in competition to stimulate efficiency and innovation. Government role in a riba-based operation, the government is to protect the interests of the property, but riba-free, it advances the human interest as revealed in all of God's messages. And I go trade and political orientation. Political orientation, the riba-free, the riba-based operation is elitist. The democracy of the money, you know, Gecko was saying greed is good. You know, if you got the money, then you can speak. People respect you. But in the riba-free system, it is a populist, the democracy of the person and what the person can bring to the table. That's all I have, and thank you very much for covering chapter 7 and 8. Any questions on that?
If there is any conflict, if RF banking want to go like nationwide or at least like nation?
Of course, the whole idea is to go nationwide, but now we talk about strategy, the expansion strategy. The problem is the Community Reinvestment Act is defined by geographical location. So when Dan or Alex sit down and look at the Community Investment Act, they look at the geography. They don't look at the underserved communities. If the Community Investment Act is designed around the underserved communities, we would be having an easy picnic. But to do that, what we're doing strategically is to first, the way we started first is start in California, all right? So we start in California, and using the law, it says 50% got to be invested in loans, and 50% of the loans should be in your assessment area. So we fulfilled that, but then we started growing using the internet. Then we started Texas, and we start growing. Then we start Illinois, and we start growing. Then we start New Jersey, and we start growing, and then we start New York, or whatever the sequence is. Now, if you think that you can compete by opening branches like Citibank and Wells Fargo and others, think again, because they will kill you. They will beat you in your own game. You don't have the resources to compete with them. So you have to compete intelligently. So how we do that? We do that using the internet, and that is the real name of the game in our uniqueness, where we can meet people and people get to know us through a word of mouth and referral. Did I answer your question? But the intent is to make it nationwide, yes. The intent is to have LARIBA Bank of America. Now we have LARIBA Bank of Whittier, but we want to do LARIBA Bank of America. And each and every one of you, honestly, will be the makers of history, I promise you. And it will be something that will be the pride of your life after I go. So remember me in your prayers.